Let's be honest, is the money you have in the bank really safe? After all the headlines we've seen lately, it's the one question pretty much everyone with a bank account is asking. And you know what? The answer is way more complex and, frankly, more interesting than you probably think.
So, if you've ever felt that little knot in your stomach thinking about your bank, you are definitely not alone. It's a feeling that gets right to the heart of the trust we put in our financial system. And as we all saw not too long ago, that trust can be shaken up in a heartbeat. The whole situation with Silicon Valley Bank and Signature Bank, that wasn't just some business news story. For a lot of us, it was a huge wake-up call. It was this stark reminder that, yeah, banks can fail. And it made millions of people look at their own bank statements and ask a really simple and kind of terrifying question. Am I protected if the worst actually happens?
We all know this number, right? $250,000. It's the FDIC insurance limit that's been drilled into our heads for years. But here's the secret that most people miss. That number isn't a hard ceiling, it's more like a building block. And not understanding that difference, well, it can be an incredibly expensive mistake.
So here's what we're going to do. First, we're going to bust that $250,000 myth wide open. Then I'll show you how to unlock way more coverage. We'll look at some actual strategies you can use, touch on the big safety net for the whole system, and finally, peek at what might be next for deposit insurance.
Okay, let's just get right into it. The single biggest mistake people make is thinking that $250,000 is some kind of simple, hard cap on their money. But the truth is, the rule is so much more flexible and honestly way more powerful than you've probably been led to believe.
And here it is. This is the sentence that changes everything. The limit is $250,000 per depositor, per bank, per ownership category. That last part, per ownership category, that's the secret key. It doesn't mean you can only protect $250,000 at a bank. It means you get that much coverage for each type of account ownership you have there.
And look, you don't have to take my word for it. The FDIC itself talks about this all the time. Their biggest worry is that good people who think they're fully insured accidentally have a ton of money exposed just because they haven't structured their accounts in the right way.
So if these ownership categories are the key to the whole thing, what exactly are they? And more importantly, how can you actually use them to protect your money? Let's break it down.
Just think of them as different buckets for your money. You have your single account, that's one bucket. You and your spouse have a joint account, that's a totally separate bucket. You have an IRA retirement account, that's another bucket, and the FDIC gives each one of these buckets its very own $250,000 insurance policy. Okay, this is where it all clicks into place. Check out how a couple can insure $1 million at a single bank. Seriously. So spouse 1 has a single account in their name, boom. That's $250K of coverage. Spouse 2 gets their own single account. That's another $250K. Now they open a joint account together. And because the FDIC insures each co-owner up to the limit in a joint account, that one account gets $500,000 in coverage. You add it all up, and just like that, they've turned a $250K limit into $1 million safety net.
All right, so now you know the rules of the game, but how do you actually play it? Well, when you're talking about protecting larger amounts of cash, you really have two main choices. You can go the do-it-yourself route, or you can use an automated service.
The DIY approach is pretty straightforward. You're the one opening accounts at different banks, or maybe you're setting up those different ownership categories we just talked about. The pro, you have total control. The con, it's on you to keep track of all the paperwork. The alternative is using an automated network service that does all that legwork for you, behind the scenes.
Now, that automated route often uses this really clever tool called an Insured Cash Sweep, or ICS. The way it works is, from your point of view, you just have one account at your main bank. But in the background, any money you have over the insurance limit is automatically swept into separate accounts at a whole network of other FDIC-insured banks. It's a way to get multi-million-dollar protection with the simplicity of just getting one bank statement.
Now, let's zoom out a bit. Beyond what we can do with our own accounts, there's this much bigger conversation about the entire system. Like, what happens when a bank failure is so huge it threatens to cause a widespread panic? Well, in 2023, we got to see the answer to that, live. So, to stop the panic from spreading after SVB and Signature Bank went down, regulators pulled out what you could call a financial bazooka, the systemic risk exception. This power basically let them insure every single dollar in those failed banks, even the amounts way, way over the $250K limit. But they were also very clear this was an emergency move to stop a crisis, not some new promise for everybody else.
So you might be thinking, why not just protect all deposits all the time? Well, it comes down to this classic economic idea called moral hazard.
The worry is that if everyone, both banks and their customers, know they'll get bailed out no matter what, there's less reason to be careful. It could actually encourage riskier behavior. Because, hey, if things go wrong, the system will just cover the losses.
So, with all that said, how worried should we actually be about the banking system today? Well, despite those scary headlines, if you look at the FDIC's own data, the number of banks on their official problem list is still right in the normal range for a non-crisis period. This kind of suggests that the 2023 failures were more about specific issues at those banks, not a sign of widespread rot in the system.
And what's backing all these insurance promises? Well, this is the FDIC's Deposit Insurance Fund. We're talking about a war chest with over $150 billion in it. And that money comes from fees paid by the banks themselves, all designed to make sure the system stays stable.
You know, the whole fire drill of 2023 really kicked off a major debate again. Is the system we have, which was designed decades ago, still the right fit for our world of instant digital banking and lightning-fast money transfers?
And that leads us to the single biggest question being debated in Washington right now. Should we just get rid of the $250,000 cap completely, just insure all deposits to prevent any future panics? Or does that open the door to that moral hazard problem we talked about? There really is no easy answer here, and whatever they decide is going to affect the safety of all of our money for decades to come.
This is not financial advice.